The best Vanguard funds for 401k plans, says Hip Kiplinger's, Dateline September 16th, 2019. So let's see what we got. You know, I'm a fan of Kiplinger's and I'm a fan of Vanguard. So this is a twofer. Remember 2 and 2, Chuck Woolery. We'll be back in 202. You remember that? Thumbs up if you remember that. Give me a thumbs up if you remember that. Thumbs down if you don't. It's okay. It won't hurt my algorithm numbers. So thumbs up if you remember 2 and 2 from Chuck Woolery. Thumbs down if you don't. It'll give me a gauge of who's my age, because when I was growing up and we'd stay home from school back in the early to mid 80s, you'd watch Chuck Woolery doing his some kind of dating show back in the day. And he'd always say, we'll be right back in 2 and 2. In 2 minutes and 2 commercials, I think. I don't know. All right, so let's see what these guys say. So Kiplinger says, if, let's see here, how do we make that bigger? Can't make it bigger, all right? If the 401k world held a popularity contest, Vanguard would win. More Americans choose to stash their retirement savings in Vanguard funds above any other firms in the country. In this, our annual survey of widely held 401k funds, 32 Vanguards rank among the top 100. Of course, just over a dozen of those funds are index funds. But Vanguard offers many actively managed ones too. So today we're going to look at some of the best 401k Vanguard funds and weed out some of the lesser options. All right. We'll review 9 active funds as well as a popular Vanguard Target Retirement Series, Target Date funds. 10 Vanguard Target Date portfolios rank among the most 100 popular funds in retirement. I get it. We'll rank each by buy, sell, or hold. Vanguard Equity Income is a buy. All right, let's just take it why that is. I'm not all that familiar with this fund. Expense rate, you got a ticker, VEIPX. You got an expense ratio of 27 basis points. 10-year returns 13%. I imagine this is date. Actually, I'm not sure when it is. End of June, end of August, not sure. But anyway, consistency is the equity income fund's hallmark. It's got to be run by Wellington. Yep, it is Wellington. Focus on large companies that pay a dividend help, of course. Over the past 3, 5, and 10, is one of several Vanguard funds included in the Kiplinger 25 and has delivered above average returns with below average risk relative to its peers. Invests in stocks with large discount price companies. Has the same team of managers for more than a decade over at Wellington, who's been running it since 2007. All right. Runs 2/3 of the assets. Vanguard's in-house quantitative stock picking group has been run the remainder third. So it's divided between 2 portfolio managers. One with Wellington, active manager, he runs 2/3 of it, and the other 1/3 of the portfolio. They do it just basically, sounds like an algorithm essentially. Together, they hold okay, so you can read all that about what they're holding. The yield's 2.8%. That's good. So it's definitely a dividend-heavy stock fund, that's for sure. So that's pretty good. The Explorer. I've never been an Explorer fan. I just even when I was working there, Explorer never did much for me. Let's see. Expense ratio is 46 basis points. Well, 10-year annualized return is 13.8. Rank among the top 41 funds, top 100 401k funds, and Kiplinger is number 79. Explorer a hold. Lumpy returns and revolving door fund managers have been a long time negative for the Explorer, which invests in fast-growing small and mid-sized companies. It looks like it's worldwide, too. Interesting. Between 2008 and 2017, Vanguard swapped out 6 sub-advisor teams and moved in 3 other firms. Yeah, a slump in small company stocks over the past year hasn't helped because it's down 1.8%. Its performance is improving, a sign that perhaps Vanguard has a good team of managers in place at last. I don't know about that. They're looking for burgeoning, fast-growing companies. It's worth noting, however, that the resulting portfolio of 500 to 600 stocks tilt more towards mid-size, such as a couple of these ICLR and POD, than small. At last report, 55% of the assets were invested in mid-sized firm, 6% in large, and the rest in small. So there you go. Mid-sized companies. Does it say asset size? They don't. All right. So equity income was number 62 on their top 100. All right. Inflation protected. It's a buy. 1 year. Expense ratio is 20 basis points. It's number 74 on its top. Bond investors who seek a safe investment that will stay ahead of inflation. I don't even need to read too much about that, but if you look at 10-year annualized, 3.2. And that's about what you're going to get. I imagine you'll probably get a little bit less. But there you go. I'm a fan of the inflation protected securities. Really am. International growth, a buy. All right. Expense ratio is 45 basis points. 10-year returns 8.1. It's number 41 of his top 100. Investors looking for exposure to international stocks. Many investors have looked at the U.S. lately, but if you like Vanguard funds, the international growth is a worthy choice. Compared with its benchmark, it's a standout. In the calendar years between 2008 and so far in 2019, the fund has outperformed its benchmark in all but 2 calendar years. And its 10-year annualized return, it beats 13% of its peers, funds that invest in growing large foreign companies. The two sub-advisory are Bailey, Gifford, and Schroeder's run the fund. Never heard of either. That literally doesn't mean anything. They look for growing companies on any size and developed and emerging companies. All right. Of course, they got Alibaba among the fund's top holdings. Be prepared for volatility with international growth, especially on the downside. Is packed with fast-growing tech firms and e-commerce companies. See, that's my problem with this stuff. Fast-growing tech firms and e-commerce. Prime Cap's always a buy. Yep. You're never wrong with Prime Cap if you can get access to it. And look, can you ever go wrong short? I say that facetiously. I'm not saying it will always give you good returns. 10 years analyzed 14.6. Expense ratio is 38 basis points. Aggressive investors with long-term Prime Cap has just been good for, literally since back when I was at Vanguard. We're going over 20 years ago. Prime Cap was stellar. 5 managers from Prime Cap and has closed to new investors unless 401k plan offers it. I don't know if you can roll it from your 401k to an IRA. I'm not sure. So if you have it in your 401k, you might want to think twice about rolling that money into an IRA because you might have to leave the Prime Cap behind. A large company stock fund, the Pasadena, California-based money manager. 5 managers pick the stocks, kind of like American funds, so they divide it up to multiple different managers, which I like. Each manager takes a slice of the fund's assets and runs it independently, but they all have the same approach. Look for companies with better growth prospects than market prices imply. Adobe Systems, Southwest Airlines, Texas Instruments shares have been in the fund since the early 1990s. That's nuts, man. Contrarian bent is showing its ugly side these days as it's up 0.8% over the past 12 months, which lags 82% of his peers. Well, that's the thing when you're doing contrarian stuff, man, you're going to get behind sometimes. The fund isn't built to mimic any index, so there'll be times it performs out of step with the broad market. The favors technology and healthcare companies. Those two sectors comprise 59% of the fund's assets. Lately, healthcare stocks have been a drag. That's tough, man. I wonder how many. Doesn't say how many holdings it has. I imagine it's very condensed, not very broad. Wellesley's a buy. 23 basis points. We've talked about the Wellesley before here. Conservative investors who tilt towards bonds but want some stock exposure, run by the Wellington folks. So I've talked about this a million times today, so we're going to overlook Wellington. Wellesley. Wellington's a buy. 9 among the top 100 for the where Wellesley's number 76 for Kiplinger's top 100. So Wellington's number 9. It's been a Kiplinger favorite since 2016. One quirk about the fund is that if you're buying shares in this fund outside of a 401k plan, you must buy it through Vanguard. I say that's otherwise it's closed to new investors. So you better get an account at Vanguard for sure. Managers from the Boston-based Wellington have run the fund since 1929, but recently the team has changed a bit. The co-managers on the bond side since 2017, but the veteran bond picker retired in 2019 June, so they got a couple new co-managers on the bond side. On the stock side, long-term manager Edward Busa took on Daniel Post as co-manager in 2019 in anticipation of his soon-be retirement. We're watching this fund a little bit more closely as a result of the imminent manager changes, but so far it's business as usual. The fund yields 2.4%. Wow, Windsor's a sell. Okay, what's up with that? Number 31 is top 100, 31 basis points expense. New manager, there you go. A long-term trailing returns are average, albeit a little ho-hum, but the fund isn't a total dog. Yeah, if it's got a 11.4% annualized return, that's not a dog. Even so, the biggest knock on how is it performs during the down markets, in a word, badly. Got a new manager, which is always concerning. But the guy from Wellington, David Palmer, he took over running 70% of the assets in 2018. A deep value style money management firm runs the remaining 30% of assets. Like his predecessor, he's a contrarian at heart, investing in out-of-favor companies that trade at relative discounts. Windsor 2 is a sell. Wow. That is the average 11.2% in the 10 years. Rank among the top 401k funds, number 96. Invests large and mid-sized companies, suffers from chronic middling performance. In 6 of the past 10 calendar years, it has lagged the S&P 500. Of course, value stocks have underperformed their growth counterparts for that period too, but even against its value peers, Windsor fails to shine brightly. Part of the problem is it tends to lose more in down markets than its peers in the index, and it fails to rebound as strongly too. Low expense ratio, but we think you're better off in the S&P 500, and they give a buy to target date funds. All right, well, there you go, man. I'm a fan. It's funny how Windsor. I remember the Windsor funds when I was at Vanguard. People were hating on Windsor, man. So there you go. There's Kiplinger's top Vanguard funds for retirement in your 401k plans, and I'd say your IRAs. Just remember, Wellington, you have to have an account at Vanguard to buy it. All right, hope you help. I hope this helps. We'll see you next time.